GDP growth is at 6.6% versus our own poll of 6.8%. I've got guests seated with me right here on ET now, and before I go across to all of them, let me try and get you some internals as we speak. Okay, Shubhda Rao and Maithili Busnurmat are there, and I'm sorry I wasn't prepared to take this conversation forward, but let's make an attempt here. Q3 GDP growth at 6.6%. Maithili, good numbers?
Well, it's in line with expectations, because remember, the CSO had also predicted that the first half we had done 7.6, and given that for the year as a whole the estimate was 7.2, we expect an average of 6.8% for the subsequent 2 quarters. Now that Q3 has come in at 6.6, we'll need to have Q4 grow a little faster in order to attain that 7.2%. Fortunately, there are signs of de-escalation of tensions between India and Pakistan. Otherwise, our Q4 number might also have gone for a toss, Supriya. So for now, given the kind of environment in which we're living, 6.6 is not a very bad number.
Actually, to tell you the truth, the government has tapered its own growth forecast for fiscal year 19. So not 7.2, it's now been talked about at 7%. That's also the data point that we are seeing in the Q3 GDP data series that has just been released. Government expects fiscal year 19 GDP growth at 7% and not at 7.2% like it was previously projected. Shubhda Rao, 6.6% is not a number that's going to put 7.2% on the table, and a lot will now depend on where Q4 numbers will be, given that our own growth projections were 7.2, now revised down to 7%. In fact, actually 7.1% earlier, now revised to 7%. Quick word on the numbers so far, because Q2 in FY19 was at 7.1%, Q3 in FY19 is 6.6%. What has caused growth to slip from 7.1 to 6.6 on a quarter-on-quarter basis?
Well, I think the first and foremost, let's get the statistical impact also out of our way. Somewhat it is also reflecting an adverse impact of the higher statistical base of the Q3 of the last year. But having said, I think very clearly there are 2 or 3 pointers that we need to pay our attention to. One was very clearly the core sector data was pointing towards a fair amount of softness in the economic activity. Likewise, the industrial production at a broader level was also pointing towards softness in economic activity. So the way we have seen the first half grow at average of about 7.6, 7.7% was unlikely to keep up the momentum given these high frequency indicators. The third and more important part, Q3 is typically associated with a festive related demand kicking in. Now that was also the time where the domestic financial conditions were getting tighter on account of the NBFC crisis and so on. So a lot of the sectors that really have an exposure to NBFCs, like automotive sector or the real estate or housing sector broadly. So these sectors definitely may have seen a downturn in terms of the momentum, and that is also the reason why we were anticipating, of course, not at 6.6. Our estimated growth of GDP for the third quarter was 6.8. Obviously, it has disappointed even from those levels about 20 bips lower. Going forward, we could probably see somewhat further correction in the Q4 numbers as well, because the incoming data does not point towards any uptick in recovery from that momentum that we had seen in H1 of the current fiscal year. So to conclude, I think it would be more of a 7% to 7.1% growth for the full fiscal year that we may have to work with.
You know, Q1 has been revised to 8% and Q2 has been revised to 7% from 7.1% earlier, just to put numbers in perspective. Very quickly, Siddharth Sanyal is also ready with us. And Siddharth, the worrying thing is that Q3 sees a lot of consumption months, you know, the festive demand and all of that. Is this primarily on the function of consumption having taken a hit because of the NBFC crisis? Is that finally kicking in into our data?
Well, to an extent, I tend to think so, because otherwise there is no major reason why consumption. And I'm yet to see the number in various components, but there is no other big reason why there should be any big deceleration in consumption otherwise. But very clearly, as Shubhda also pointed out a few minutes earlier, that the way the financial sector, NBFC sector in particular, which had been financing a lot of or fueling a lot of growth in terms of some discretionary consumption space in many cases in recent months, came under a lot of pressure. What can be a bit of a positive on the consumption space, actually consumption staples in particular, going ahead, the kind of rural support schemes which has started becoming operational now onwards, and this money is going into the hands of people at the bottom of the pyramid where the propensity to consume is nearly 100%. So that can actually be some bit of a positive, but mostly beyond the Q4 of the financial year. Possibly we'll see the benefit only in Q1 of the next financial year.
Yeah, that's true, because Q1 and Q2 have both been revised down. Q2 has been revised down to 7% and Q1 has been revised down to 8% from 8.2 earlier, just to put it in perspective. But M. Govindrao is also with us. And sir, what does this data point to in terms of future growth? In terms of Q1 of, actually Q4 of FY19 and Q1 of FY20, where do you believe this data is pointing us in this direction?
You know, the whole year growth is likely to be sub 7%. This is mainly because, you know, I heard, sort of why the consumption is decelerating. See, if you have seen, both in Q1 and Q2, public administration has been one of the major pullers of growth. 10.9% in the third quarter, in the second quarter. Now going further, neither in the third nor in the fourth quarter you are going to have that particular thing. Now manufacturing sector may marginally improve. So, if you want to really have a 7.2% growth, with 8% growth in the first quarter and 7.1% growth in the second quarter, you would need 6.85% growth in the next two quarters. There is no way, that is likely to happen. Even if, this rural consumption, as was pointed out, the 20,000 crores that was budgeted, I think there will be a lot of hiccup in basically implementing it in within the next 30 days. And, that is not going to pull the growth rate very high. Things might happen better in the next year. But I think for the whole year, 7.2% growth is definitely out of question. And if you are able to reach 7, I think we should be very happy. I'm not saying that 7% is low. I'm quite happy with 7%. But the point is that let us not be overly optimistic.
Actually, I think in India we are very schizophrenic about our growth. When we want our RBI rate cut, we say our growth is very low. And when we otherwise want to chest thump, we say our growth is very high. So I think the reality somewhere lies in between. But Maitri, I've got internals with me right now. And I think that presents a little bit of a worrying picture, because manufacturing is at 6.7% versus 8.6% on a year-on-year basis. I'm just comparing year-on-year numbers right now. Mining has picked up, and I think there was a contraction of over 2% in the previous quarter. It is now at 1.3%. Farm sector growth, and I think that is the piece to worry about, and I hope that some of the cash transfer and all that is happening will perhaps help on that count. 2.7% versus 4.6% again on a year-on-year basis. And construction, I think that is the good story. It's gone up to 9.6%. It has a spiral effect. It has a positive effect overall. So that's gone up versus 8%. Your quick take on the manufacturing data and also on construction. Do you believe that can take care of some of our woes single-handedly?
Well, not entirely. And the manufacturing thing I would think is particularly worrying, though of course it is true. The construction is also a job creating sector, so is manufacturing. And remember, Supriya was speaking about low consumption. Now, one of the reasons consumption is low is because real interest rates in the country are so astronomically high. It's about 4%. And in August of last year, the RBI hiked repo rate by 25 basis points. In October, it went in for calibrated tightening. So the result of all this was that consumption really took a hit. Not only was money tight. Not only did the NBFCs have problems about liquidity, you also had very high real interest rates. It's no surprise really that consumption took a hit. And I agree with Dr. Govinda Rao that government has very limited room to spend. So the kind of support that you got from public expenditure in Q1 and Q2, you are not going to see in Q3 and Q4 going forward. So we'll be lucky if we reach that 7%. Of course, again, as you said, 7% is not a bad number, but it's nowhere near our potential, and it's nowhere near the kind of growth we need to see in order to have jobs. So clearly this is not very happy news for our government going into an election.
Yes, it is in, but Shubhda Rao, I think the important point is the Q. I'll take a quick preview from what Maithili was saying, that public expenditure is traditionally front-loaded, and which is why you saw higher fiscal deficit numbers for the first 2 quarters. Public expenditure being front-loaded, Q3, Q4 is not going to see the kind of public expenditure that we have seen. On that count, how worried will you be? Because, you know, sectors that should be creating jobs, sector that should be creating employment opportunities, and verticals like mining, you know, it has obviously gone up from a contraction of over 2%, but it is at an anemic 1.3. Manufacturing has actually come down to 6.7 versus 8.6 a year back, and farming, and I think that's the big place of bother, 2.7%. And remember, public expenditure will not be the knight in the shining armor, at least in Q3 and Q4.
Sure. No, quite concur with what Maithili was earlier observing in terms of where the drivers of growth should be if we are tracking the third and the fourth quarter numbers. Consumption, as we have been discussing in the show, you know, particularly emanating from the rural side, has been the bugbear for this year's growth drivers concerned. But importantly, if we are looking at it from the scope of how we are going to see it going forward, will the government be able to prop up this consumption? Probably revenue expenditure would continue, but it's the capex which we typically say, you know, when the axe falls on meeting the fiscal targets, is obviously the capex that suffers, and that's where the jobs and everything gets created. But having said, I think even it's the urban consumption that is also, you know, facing the flag. If you look at the high frequency indicators, even the aviation traffic, or you look at high-end consumption expenditure, those have also begun to correct, and consumption as an overall you know, pace in terms of driving growth has seen a beating, be it rural or be it urban. Brings us to the point of capital formation. Now here where I would like to dwell on is, while we know that the government has been doing the heavy lifting as far as capex is concerned, recovery of investment cycle is concerned, but over some period of time we have seen some sporadic improvement even in the private sector spending, not broad-based, not intense in magnitude, but it is not a complete standstill. If you pay attention to a little bit of a capital goods production composition, you know, we may conclude that some bit of it that comes from government is active in terms of roads, but also in terms of private sector led capex in some of the manufacturing areas in newly created states. We are seeing some impetus for the private sector capex getting better. Now, clearly for a sustainable growth going into the next year, we will need a more broader pickup from the private sector to show some recovery. Output gap is not completely closed. It has opened up a little bit, but I think there are too many moving parts to you know, ensure that how do we keep the momentum ticking. We have the geopolitical risks. The one good point going forward would be, you know, the oil prices have somewhat stabilized as compared to the October-December quarter, and so also the currency. We live with uncertainties, but compared to the earlier quarter, the fourth quarter will see some relief as far as oil and currency are concerned. That itself should give some support to the growth momentum. But having said, yes, I think 6.9 to 7 is probably what the number will eventually look for. We would look for in the fiscal closing of 19. Going forward, a lot rides on the election outcome and other geopolitical outcomes, but our assessment is going into the next fiscal year, we may see an improvement of at least 20 to 30 basis points to the least, if all things go right in election outcomes, at least a 30 basis point improvement in growth into fiscal 20. Not a terrible number when globally we are grappling with growth getting better. But yes, as Maithili also pointed out, compared to our own potential, we can do better if our policy orientation remains very strong towards the domestic drivers of growth.
Okay, give me a minute, because that's exactly the question that I have for Siddharth Sanyal. And Siddharth, what do you believe will be the tailwinds going into the next fiscal? Because, you know, whether it was oil that was a headwind or the kind of violent currency moves that we were seeing is a thing of the past. We have a rather stable oil regime right now and somewhat a stable currency. So is that going to be a tailwind? And do you believe that tailwind can get corroded by the big headwind, the big cloud, or the big fog of uncertainty, which is elections?
Well, to some extent, the tailwinds you cannot ignore, because you mentioned about the currency. That's a valid factor. You mentioned about the stability in oil prices. That's also a very important factor. What you didn't mention is also there is a downward movement, potentially downward movement in interest rate, and potentially it can go a little lower. And compared to bulk of 2018, in 2019, the liquidity stance from the central bank can also be slightly more supportive. So overall, there are a few tailwinds that is in play. Obviously, the election whether the election turns out to be a tailwind or a headwind will possibly we just have to wait, and there is no point taking a guess on that, because that can on its own can be such a big factor, and we need to really see what exactly in store. But what I would like to see in this particular data, and which is not there in as per my construct as of now with me, that this downward surprise in data, whether it's driven more by a surprise in the net exports part or a surprise in the domestic demand part. Last quarter, when the data was initially reported as 7.1% and turned out to be a negative surprise, the negative surprise didn't really come from domestic demand. It came from the net exports part. My sense is that if it is still because of net exports contributing to this downside surprise, it's a lesser evil. And if domestic demand is holding up already, then it's possibly a better prospect for us, because net exports will likely turn a slightly more favorable into a slightly more favorable zone in the coming quarters. But if it is now, if we figure out that actually domestic demand is turning further weaker, then possibly you have to watch this space a little more closely, and that is something I need to figure out once I get a chance looking at the details of this particular data.
Okay, if I could come to you now, M. Govindara, this is Nayantara Rai. Now, you've seen a downward revision for Q1. You've seen a downward revision for the full projection, for the full year as well. So going in the last quarter of the year, the last quarter which is going to decide the full year figure as well, what according to you would be the tailwinds? You just heard what Siddharth's views are.
Well, the question is, I think we should reconcile ourselves to the fact that we are not going to sort of have a very high growth. Number one, the election expenses have not yet started, and there will be much more election expenses going into FY19 as compared to the current year. As far as and then, of course, my own hunch is that there has been a deceleration in the domestic demand as well. In fact, that was the only driver of growth, and there have, since much of the pay commission award and various other things have been, front-loaded, there was a lot of spending on that account in the first 2 quarters. Obviously, the next 2 quarters is not going to grow. Of course, the expenditures will happen, the revenue expenditure will continue, but then the growth of these expenditures will not be high. Investment demand is likely to pick up, but the government investment demand is not likely to pick up, partly because, in fact, you see the fiscal deficit One is, as Maithili said, the real interest rates are very high. Part of the reason is that the household sector financial savings are not very high. And then the government has been, it's not just the fiscal deficit at the center and the state. There has been so much of off-budget financing that has gone on. And, if you look at the PSBR, it's much higher, almost 8%. And then at that level, when you don't have the, even if the Reserve Bank reduces the interest rates, the transmission will not take place. And then, of course, the Reserve Bank will come up now by saying that we will monetize the deficit by one way or the other. That's one of the possibilities that happen today. They are talking about, releasing 1 lakh crore of liquidity. Maybe it is necessary, but then, one has got to be vigilant as we go along. So in any case, the Q3, so the Q4 numbers are not going to be very encouraging. Let us reconcile to that. And the whole year growth will be just about, if you touch, as I said, 7%, it would be happy. Going next year, obviously there will be a lot more of election expenses that may take place, but then don't expect that the Q1 figure to be 8% as compared to the previous year, because I think, though I believe, there will be some improvements in the, this twin balance sheet crisis, and there will be some more private investment demand take place. Exports in any case have been stagnant. And, I don't really see much of a boost to the growth from the exports coming. Of course, oil prices is always an unknown thing, but they have stabilized, and we hope they will continue to be stable in at least in the foreseeable future.
Maithili, if I could come to you, you're seeing the full year projection also coming down. Q1 has officially been revised downwards. This is not the ideal situation, perhaps, to go into elections with an economy which is, showing signs of slowing down, or at least not even meeting the government's own targets. But having said that, in the run-up to that, you have seen certain steps that are taking place. For example, liquidity is back. The RBI is doing what it can to ensure there's liquidity. The credit offtake is going up. You've seen the direct transfer to the farmers, however small the amount may be, beginning just 2 days ago. Do you think any of that will really come out to help?
Well, yes, the fiscal transfers are likely to have an impact more quickly than the monetary policy easing, because monetary policy typically acts with a long lag of maybe 4 to 6 quarters. So I think as far as the RBI is concerned, it's been too little too late, and we're paying the price for that excessive tightening that we saw during Urjit Patel's days. So I think, I'm afraid, we'll have to live with that. But the fiscal easing should help, but I don't see any improvement in the next quarter either. Perhaps in the first quarter of the next fiscal, of course, depending on what kind of election outcomes we have. If we have an election outcome that is, far from clear, then that political uncertainty will certainly depress GDP further. Hopefully, we will not have that. We'll get a clear election results one way or the other, and that will help stabilize. And so Q1 of next year should hopefully be better. Also, we need to keep our fingers crossed that the present tension between India and Pakistan does not escalate, because if it does, that would certainly be bad news, not only for GDP in first quarter of next year, but also in Q4 of this year. Nayantara.
That's right, of course. Any kind of tension, escalated, or a war is bad news for any economy. But having said that, at this juncture, we are out of time. So I'd like to thank all 4 of my guests for taking the time out to join us here to decode that important macro data that is out. You've got a third quarter GDP coming in at 6.6%. You've seen a downward revision for Q1 as well as for the full year projection. And with that, I'd like to thank you, the viewer, for tuning in. But stay tuned to ET Now. After the short commercial break, we've got a lot of news and updates, important interviews lined up for you. Remember, at sharp 7 p.m., the Army, the Air Force and the Navy will also be holding a joint press conference.